rise.
Well, there's still a lot of concern as to the future of our markets with regard to how the subprime mortgage crisis has affected the markets. Geoff, I have to bring this back to you again from the institutional side. What are you seeing as far as guidance by the Fed and how it's affecting some of the hedge fund managers, the banks in particular? What are you seeing there?
Well, I think it's going to ultimately go back to the deleveraging of the institutional buy-side community. Mm-hmm. And if you looked at last year, the average hedge fund got over to where they're 200% leveraged. Mm-hmm. They're 150 long and they're about 80 short. And now that's coming back down. The hedge funds now have the lowest exposure they've had in a number of years. And I think that's due to the deleveraging. As we deleverage, pretty much everything, they're going to get the impact of that as well. Their prime brokers are going to get tougher on them. I mean, witness Bear Stearns. Bear Stearns really had to be acquired by J.P. Morgan because it was not a run on
shock.
It was not a run on the assets of the individuals holding accounts at Bear Stearns, but it was really more the hedge fund managers that said, I can't stand to have these guys go under. And we had a great example of that 2 years ago with Refco. Refco went under, and all those hedge fund managers that were primed at Refco are still dealing with their asset values.
What about the bank, the financial sector? Rick and I, we were doing a Canadian tour. We had several investors come to us and ask our opinions on Citigroup. And we were trying to describe to the audience that there are good companies and there are good stocks, and these two don't necessarily have to match up with one another. We saw that for the longest time, Citigroup has been a downward sloping trend, and
regardless of what you thought about the company,
and we still haven't seen a bottom, and this is the case for even some of the banking stocks that are out there. What are you seeing with regard to the banking sector?
Well,
right now?
if you look at
if
you look at the other crises that we've been through, the tech bubble, that was 2000 to 2002, so that was a 2-year period. If we look at the savings and loan crisis, RTC, that took multiple years to work itself out.
But we recovered.
We recovered, and we'll recover again, but it's going to take a period of time to recover, and we're going to be living with tighter credit for a period of time, and we're seeing the ramifications of that across the board. Look at American Express recently; they had tougher earnings for the quarter. They're clamping down, putting in tighter standards. The car guys, you're now starting to see it with the automobile companies. They're having a tougher time making loans, and it just means that the U.S. economy is going to slow for a period of time before it can recover.
Now, we just technically, when we're looking at the markets, we have a bias through the rest of 2008 as a negative bias. We think the markets there's going to be pressure on the markets.
It's just based on the trends that we're seeing.
Yeah, exactly. It's just
simply
the technicals, not looking at the fundamental underpinnings of the economy. But let me ask both of you to weigh in on that subject. Do you think we're at the beginning, the middle, or the end of this weighty cycle that we're experiencing?
I think so. It's very important to distinguish between the stock market, what the stock market will do for the rest of the year, and really what the economy will do. Okay. I guess I fall into the camp where I think that it's going to take 2 or 3 years to work out the underpinnings, the problems that we're facing. However, I think by the end of the year we're going to be over 14,000, and what I'm telling my clients and people who read what I write and that I advise is that they have to think about the period, and I think I brought this up on the last show, that I felt that we were in 1967-68. I think we're really in 1971, and that when we look back 10 years from now, we're going to look at this crisis has been the time to really go and buy really great equities and to buy great real estate investments, because what is the Fed doing? The Fed has stepped in and said, look, we're going to go ahead and we're going to guarantee that the system stabilizes. We're going to provide enough liquidity. Well, they're doing that, and they're doing it, and it's expressing itself in a lower dollar, which means from 1971, there were people who owned houses that were $15,000. And by 1979, these houses were $150,000. Didn't mean that the $150,000 would buy what the $15,000 would have bought, but people felt much more secure. We're doing what has happened since the Byzantine Empire. We're demonetizing and deleveraging, but at the same time, while we're having tighter credit on individuals, we're giving wide profit margins to the banks so that they can make up the losses that they've suffered, improve their debt-to-equity ratio
with of
inflation and more printed dollars and more printed currency. And in some senses, I think it's fair to say this might have been the most serious financial crisis that this country's ever faced, and it may very well turn out that the it's not like the Depression, where you had a depression from 1923 to 1928 in the Dust Bowl, a farming depression. Then you had a financial depression. Then you had, pervasive fear, which Roosevelt, addressed, where the only thing we have to fear is fear itself. And through that whole time, the federal government really didn't inflate until the war started, the Second World War, and then that's where we are. And you go now to the Vietnam War era, and you look at the guns and butter, the social policy, and how to go ahead and turn things around. So I think we're in 1971. I think we'll see 14,000
Okay, all right.
by the end of the year on the stock market.
Well, I think we've had a good mix today on this program, and I'm really happy that both of you are joining the team, because this is only going to continue on into the next programs. Give us an idea of what you have lined up for future guests, so that our viewers
I got some great guests. I have one guest, for instance, that's going to show our viewers how to leverage the real estate crisis into profits of 15 to 40% on their money, safely, completely secure, in a secured manner, by stepping in and becoming your own banker. So I think that's a really exciting show that's coming up. We have another show with Dan Hasse, who's appeared as an associate editor, where we'll talk about really what people should be buying in the energy sector.
Or even how to manage the risk within the energy sector.
Exactly.
Like, you don't even have to be looking to buy, you just have to be a good risk manager, and that's what a lot of what the hedge funds are doing now.
And Dan has developed a program that works very well using covered call options, which you guys are very aware about.
Very big fan.
And I will say that there's some stocks that are trading for $50 and $100 that we've got costs in at $12 and $13 because we've used
lowered the cost basis,
which goes to the best way to solve fear is with education.
And we could talk about that as a future show, too.
Absolutely.
Thanks again for joining us today.
James, Geoff, thank you very much.
Well, this wraps up another episode of Wealth and Wisdom with the Market Guys. We hope you've enjoyed the programming today. As I mentioned at the beginning of the show, please make sure you visit the website, www.wxel.org. From there, you'll be able to click on the programming tab and submit your comments through the Wealth and Wisdom page. So again, this is AJ Monty, the Market Guys.
I'm Rick Swope with the Market Guys, and just remember that we are expanding the show. We're going to be out on the street taking your questions and comments, so be sure to be a part of the show each and every week. Thank you for joining us. Have a terrific week.
To receive a copy of your favorite Wealth and Wisdom episode, or if you have a question or comment about our program, please feel free to write us at Wealth and Wisdom, care of WXEL, P.O. Box 6607, West Palm Beach, Florida 33405. Or call us at 1-800-915-9935, extension 4477. We look forward to hearing from you soon.